In this video, I'm going to talk how to use free cash flow to firm model to estimate the intrinsic value of a firm at introductory level. Before you come to this point, you must have done research about the firm to understand the business and industry, identify its major value drivers, analyze its historical performance, have projected financial statement, and have some idea about the long run growth, and you know how to compute free cash flow to firm using projected financial statement. This model uses one of the basic principles of finance, that is, value of any assets is equals to the present value of all the cash flows it can generate during the life of that assets. This is the basic principle of finance, and this model uses this fundamental concept and tries to calculate the value of that business. So according to the free cash flow to the firm model, the value of any business is equals to the present value of all expected future cash flow, which is mathematically equals to this. How you use free cash flow to firm model to value the business depends on your assumption about the future growth of the cash flows. Generally, people make two kinds of assumptions. One, the cash flows grows at constant rate, and two, this cash flows grows at non-constant rate. Usually at the higher rate towards the beginning of the life of the business and a lower and more stable growth rate towards the maturity phase of the business. Next, I am going to provide an example for each case. This is a constant growth case. We are assuming that cash flow is growing at the same rate for the rest of the life of the business. In this case, the value of the business becomes this. So here, the current year's cash flow to the firm times 1 plus long run growth rate of the cash flow over weighted average cost of capital minus the long run growth rate of the cash flow. Once you compute the enterprise value, you can also compute the stock price based on the enterprise value. And the way we compute the stock price based on enterprise value is this. So what you do is enterprise value plus the liquid asset, which means cash, short-term investment, minus total debt over number of shares outstanding. So here I have an example, and I'm assuming that there is a firm whose weighted average cost of capital is 12%, and long-term free cash flow growth rate is 5%, and current year's cash flow is 220. Given this information, what is the value of this business? So if you remember formula, the value is simply equals to, right, this period cash flow, which is 228 times, right, times 1 plus long run growth rate of the cash flow, which is here 5%, right, over the cost of capital, which is 12% minus 5%. So by following this formula, you can calculate the value of the enterprise, and which is going to be simply 3425. And I have also shown this computation here in Excel. You can see. So this is the current period cash flow, and to compute the enterprise value, you simply use the formula here: current period cash flow times 1 plus the growth rate over the weighted average cost of capital minus the long run growth rate, right? And this is how you compute the enterprise value. Once you compute enterprise value, you can also calculate the share price. To compute the share price, what you do is this is our cash and marketable securities. So if you add cash and marketable securities back to the enterprise value, that gives us the total assets, which is 3883.46, and we have the date 320. That's the current total debt. And if you subtract that current total debt from the total assets, you get the equity value. And if you divide this equity value by the number of shares, then you get the share price. Let's talk the variable growth rate of cash flow case. Here we are assuming that cash flows grow at higher rate for some time and then grows at lower rate for the rest of the period. In this case, enterprise value equals to the present value of all cash flow during the high growth period and plus the present value of terminal value. And the terminal value usually is the value of the business at the end of the non-constant growth period. It is usually computed by assuming constant cash flow growth rate for the rest of the life of the business. The formula to compute the value is this. Here the firm value is the sum of the two components here. The first component refers to the present value of the cash flow that occurs during the high growth period. The second component refers to the present value of terminal cash flow. See here how you compute the terminal value. The first portion right here is terminal value. And if you multiply this terminal value by 1 over 1 plus the cost of capital to the power of whatever the planning period or the high growth period is, then you get the present value of terminal value. Like in earlier case, once you know the firm value, you can compute the stock price, and to compute the stock price, you again add the liquid assets, which include cash, cash equivalent, and short-term investment, and subtract the total debt and divide by number of shares outstanding. So now let's look at an example here. So in this example, we have a company whose cash flow this year is 228, and we are assuming that true growth rate for the next 5 years it is growing at higher rate, which is 10%, and from 6th year onward it is going to grow at 5%, and the cost of capital for this business is 12%. Given this information, what is the value of this business using this model? So to illustrate the example here, I have a timeline. So what you do is you compute the cash flow for the high growth period, and after that you compute the terminal value using the constant growth rate. And once you compute all the cash flows during the high growth period and the terminal value, you can discount them all to the present and add them all, and you can find the value of the business. So see here how I have computed the cash flow during the high growth period. So we are given the current year's cash flow, which is 228, and we know next 5 years growth rate, which is 10%, right? So you can multiply the initial cash flow by the compounding factor, and you can compute the cash flow for the next 5 years. And once you compute the cash flow for the next 5 years, then you can compute the terminal value, and you can discount them all, and you can compute the value of the business, which I have done in the next slide. So here, so once you have all your future cash flows as well as the terminal value, see here how I have computed terminal value. Terminal value is whatever the cash flow is in 5th year times 1 plus the long run growth rate, which is 5%, right, over the cost of capital, which is 12% minus 5%, and if you simplify that, you get 5,508. That is the terminal value. And once you compute that terminal value and you sum 5th year's cash flow plus the terminal value and discount it to the present, and once you compute the discounted value of all the future cash flows, then you can sum them all and get the value of this business, which is 4,206. And I have exactly done the same thing in Excel. In Excel, I have also further computed the stock price. So here I have listed the given information on the top, right? And I have computed the cash flows for the next 5 years, as well as I have computed the terminal value. And to make this easy to understand, I have also shown the formula how I have computed. Look at the formula and try to understand how we have computed this. So here the terminal value is computed using that constant growth assumption example, and once you compute the terminal value, you can calculate total cash flows, right? Add this to all, and once you compute that in Excel, you don't have to discount individually. Excel has an NPV function. NPV can discount all your cash flows at one time. That's why I use NPV and the discount rate and all your cash flow, and that gives us the enterprise value, which is 4,206. And once you have this enterprise value, you can add cash and marketable securities and you get the total assets, and you subtract your total debt from the total assets and you get the equity value. And if you divide this equity value by number of shares, and you get the stock price per share. All right, thank you.